Thank you all very much. And so, yeah, for those who I haven't met, my name is Bill Kieser, and as mentioned, I'm a principal here in the Ares Quantitative Research Group, or QRG. So, as a quick background, QRG is a 16-person team of quantitative researchers, software engineers, and data scientists. And from a high level, our group uses math and data to better understand financial markets and investments, especially as it relates to private or so-called alternative investments. Our group has three broad mandates. The first one is to improve the investment performance of Ares products. The second is to help make our investors better at what they do. And the third is to innovate and to develop new products. So, in short, we always want to make sure that we're on the forefront of what is new in markets. So to accomplish these goals, we work with portfolio managers, investors, and academic researchers to answer common questions such as how much of a manager's returns come from alpha versus beta, how to construct an optimal portfolio, how to assess the risk-return trade-off in private markets. And a question that is near and dear to all of us and that we're going to be diving into today is how to time the market. So from a high level, you can think about our group like we seek to answer many of the same questions as public market quants. However, we operate in private markets where the asset classes and strategies are much more diverse and where we do not have the luxury of daily mark-to-market price data. And today I'm going to be presenting some work that our group has done on the topic of whether or not investors can time the market, and to be specific, whether investors can opportunistically time commitments to private funds to earn excess returns. We've done a lot of research over the last 2 years on this topic. We put out one white paper last year, and I'm proud to say we have a German version of the paper set to be published in Absolute Private Markets in the next month or so. And aside from these two papers, we've been pushing forward this research project, and we're going to talk about some of the findings today. So to that end, I'm also joined on the line by Jason Bay, who's an analyst here in QRG and has worked to really push forward this research on market timing over the last year. Before we begin, I just want to emphasize that the presentation today will only cover a relatively small portion of our market timing research. But we're more than happy to provide additional materials and or schedule follow-up calls if anyone is interested in diving deeper into this topic. But without further ado, let's jump on in. So we're going to set the stage first by looking at the long-run relationship between public and private real estate, just to kind of fix our mind on this market. So we have four indices on this chart. We have the Nareit All Equity REITs Index, which